Four, three, two, one. Welcome to the Capital Gains Tax Solutions podcast, also streamed on Expert CRA Secrets podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy when exiting highly appreciated assets such as the Deferred Sales Trust is an amazing way for you to create and preserve more wealth. So you can help your friends, family, or clients exit really smart, right? Because it's 25 to 50% in capital gains tax and depreciation recapture. 1031 exchanges can be really challenging. Cryptocurrency exits, if you didn't exit a couple months ago, you're probably kicking yourself, right? If you had the deferred sales trust, you can sell high and you can diversify and buy low. And so for those who don't know me, my name is Brett Swarts. I'm founder of Capital Gains Tax Solutions, and I'm the host of the podcast today. And we love to bring in some of the best real estate, financial, wealth, sometimes cryptocurrency, and sometimes construction folks who are building places, investing in places, to speak to us about how to create and preserve more wealth, and hear from them their stories and their inspiration. So I'm excited about our next guest. He's out of the great state of Michigan. He says, "Go Spartans," for those who are curious. And he's on a mission to help people create and preserve more wealth, and by building properties, investing in properties, in basically single family rentals. And it's a unique real estate model that we're going to be talking about today. Please welcome to the show with me, Mike Callis. Mike, how you doing?
I'm doing awesome. It's beautiful here in Michigan. We're down on that last part of spring. The kids are going back to school. I've got four of them, so four boys. So it's good to see them getting started. And I feel really grateful to get to connect with you on the West Coast.
Excellent. Mike, for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah. So, my story started when I worked. I was 18 years old, and I worked a whole summer loading rocks onto a truck. It was actually at a place called the Rock Shop, and they sold rocks. And so I worked 60 hours a week, made $10 an hour plus overtime. Saved up $16,000, and that was supposed to fund my first year of college. And two things happened. One was my parents got divorced the week that college started. So any kind of support that I thought I'd have financially dried up. And the second thing is I put the entire amount into WorldCom. So when all my friends who went out and just bought a car or did whatever, when I sold it 3 months later, I got $200 from every single thing that I'd worked for in the summer. And it really changed my view on investing. My dad was a stockbroker. And so everyone would say, well, isn't your dad smarter than that? But the books were cooked, right? So we looked at the books. They looked really good for that company. But unfortunately, there were people that weren't real good. So ever since that time, I've really tried to explore alternative ways to invest. And for me, I've always found that investing in businesses and real estate has been a little bit better. So fast forward, I got through Michigan State. I went to work for Pulte Homes, worked a little bit through the upswing of the market, and was able to do really well selling real estate at a young age. Left right as the market was starting to go down. We kind of saw that happening and started a business that was counter-cyclical. So what we did is we ran a trade-in service. We were kind of the first iBuyer, where we would purchase people's real estate if they were buying a new construction home. So we'd take margin out of the new home, we'd purchase their old one. And this was back in like 2007. So it was kind of before the Open Doors and OfferPads of the world. So we started that. We were on the Inc. 500 list 4 times in a row. We went from 1 to 120 people. We ended up managing 5,000 properties as a part of that and sold about $2 billion worth of real estate. When the market actually got better is when our counter-cyclical business got worse. So we had to kind of change and shift. I ended up selling that company and partnered with one of the biggest builders in Michigan to build 750 homes, about $250 million worth of value in single-family build-to-rent over the last 4 years. The drama came when COVID happened. In Michigan, they banned new construction. So there's kind of a period there where I thought, like this is going to totally stop. Like, how can I keep going if it's illegal to do the job that I'm supposed to do? And then defying all predictions, once COVID let up, our homes appreciated dramatically. So we closed out that fund. About 12 months ago, I started my own fund where I'm the majority partner in it, which is Great Lakes Investments. And that's what we've been doing for the last year, is a much more scaled down version. That one we did pretty big, but just keeping it small, just building 2 to 4 homes a month, and doing new construction, build to rent. And from managing 5,000 homes, from flipping 500 homes, from doing all these different things, I have found that this is one of the absolute best models to make money in in investing in real estate that I've ever seen.
Excellent.
And
Amazing.
Go through some of the reasons.
Yep. And we will be. We're talking about build to rent, build to invest. What a story, Mike. Wow. What a background. That is such an amazing story. Thank you for sharing that. Mike, I believe we'd all be given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Some people call them strengths, some people call them superpowers. But I think they're God-given gifts, and they're just here to help to get to they've been given to us so that we could be a blessing and help to others. So I'm curious, go back to those high school days, Mike, the earlier days. What are the gifts that you believe you were just given, and how does that help you help and bless people today?
I'm genuinely gifted to make others money, but it has a real weird caveat. It's that, like, I can't make a whole ton while I'm, so it doesn't work if I'm selfish with it, and that might sound a little bizarre, but it's absolutely true. I grew up, like I said, my dad was a stockbroker. I could tell you the price of Ford when I was 8. We sat around at night, and that was what we read, was like, what things were trading at and what was moving, and so I was always around that. That's what I loved. And I loved building businesses and putting things together and helping people make money. I've just always had a thing for that. And I feel like there's a little bit of clairvoyancy in just being able to see what's going to work and what's not very, very fast.
Amazing. Love those gifts. So let's dive right into the topic at hand, which is build to rent, build to invest. So Mike, and by the way, you can learn more about Mike Kellis at greatlakeinvestments.com. That's greatlakeinvestments.com. So Mike, what's the number one secret to build to rent, build to invest?
The number one secret, which is sort of a secret, but it's the margin that builders have. So when we got into this, they're published. So if you don't believe me, the public builders, you can go and look at their financials. But, a normal builder is probably going to sit on a 25% margin on homes. A really good builder might be in the 30s, and a poor one might be, in the teens. But, for our purposes, we're able to come in around 25%. And what that means is that if you're building a home for rent, the day that it's done, if you put 25% down to build it, you've doubled your money. The other part that's really neat is you've limited your downside. So I have some people that go, well, what if the market drops? Well, on our homes, it'd have to fall 25% before it touches $1 of your equity. So I think for a lot of people, that's really attractive. So you kind of have a higher upside beta with a lower downside beta. I think that's probably the number one thing that when people hear build to rent, they kind of go, well, how does that work? And
okay, let me break that down, right? So what you're saying is the margin is about 25 to 30%, right? And so if you're doing the work and you took 25% down and you got a loan on the rest of it, the moment it's completed, and if you rent it out, basically you're already ahead 50%. Is that a fair summary, Mike?
Yeah, you're up about 100% on your money if you put 25% down.
Right, 100% of money.
Is from a debt stack, the bank likes that because you're coming in at 50% loan to value, right? So that's a pretty low risk loan. So you're able to get, very reasonable financing on that type of an arrangement. But you're able to use leverage in a pretty unleveraged way.
Excellent.
If it makes some sense.
Makes sense.
The biggest reason people don't get it is most builders aren't willing to give you the margin.
Mm-hmm.
So most builders will say, it's great. You can certainly rent one of my homes. It's listed at $300K. You can buy it at $300K. Thank you very much.
Yep.
And we've really kind of went and said, you got to start from the very beginning. You got to do the land acquisition. You have to be able to build the home. You have to be able to manage the home. You kind of have to do it from soup to nuts to really be able to get the full value.
Excellent. What's secret number 2 to build to rent and build to invest?
Well, the cap rates end up being surprisingly high, and it's sort of part of the other one, right? So if you're buying anything at 25% below market, you're going to end up with a cap. So our homes end up running a 7 to 9 cap. If that was multifamily, well, I don't know. You may know better. You're on the commercial side. Well, what are multifamilies trading at in California out there right now, Brett?
Yeah, we just did a deal for 3.7 cap here in Sacramento, 48 units, 1964 construction, mostly twos, C property, C plus, B minus location. But needed about 10 to 15,000, maybe 20,000 per unit for renovations with its cost of construction to get the rents up by about 500. So they bought it at 3.7, but that delta was about $500 to $600 per unit post renovation. However, there's rent control, and that rent control is limiting, how much you can do per year for increases, and also means most of the tenants want to stay because they know it's higher somewhere else. So the question is, how quickly can you get the tenants out? Is there cash for keys? Number of these things that are going on. So yeah, 3.7 for a recent deal that I just closed.
Got it. Is that fairly typical to have rent controls out there?
Yeah, I call it California now. I mean, it wasn't 2 years ago, but now there is. It used to be just kind of like cities like some Los Angeles or like San Francisco. But then about 2 years ago, they went statewide rent control. Basically, it's CPI plus a percentage, right? So Sacramento right now, you can still increase the rents by about 9 to 10%. So it's not horrible, right? But if you wanted to go higher, you'd have to have the tenant vacate.
Yeah, and I think that's one thing, in the Midwest, you just don't have that, barring out Chicago. But where we're located in West Michigan, I would be blown away if that ever happened, just with the different environment and things that are here. So I think that you've got a little bit more upside on appreciation potentially. And so I think being able to hit that sort of a cap rate gives you pretty strong cash flow. And I think relative to a multifamily seems pretty good. And that's kind of the other secret. We discovered this in 2007 when we started our management company, was that we ended up managing homes in 38 states from one spot. And technology has just fundamentally changed over the last 10 years. You can manage single family homes maybe more efficiently than you can manage multifamily homes. And here's why. Every single thing is remote. So electronic payments, everything's made on a portal. We do all remote showings. So we run it through a call center. So we can do showings in Hawaii, California, Florida, wherever. So it all goes through the same spot. So people get in there quickly. The only thing that's localized is your local trades and vendors. But it sort of forces us to call the right people. Sometimes when you have on-site management, they're trying to fix a furnace, but they're not really an HVAC guy. So in a weird way, it just forces us to say, you got to have an HVAC guy go fix this. You pay a little bit more, but it ends up getting fixed better. I think that is something that perception-wise, for most people investing in multifamily, they think single family, the management fees are going to be out of control. And they're not. For example, we charge 4%. To manage single family homes. I think that's pretty reasonable, and we can do that all right, just because of the huge technology improvements over the last few years to do that.
Excellent. So number 3 secret is technology, realizing that maybe it's a false belief to think that multifamily is going to be easier or cheaper to manage. And in fact, single family homes, and you probably have a higher quality tenant, a little more pride of renting, and you probably also have a longer term tenant, right? Is that a fair summary, Mike?
On parts of it, and on parts of it, it's the opposite. So I have managed real tough homes. So we managed homes. I'm from Detroit, right? So if you want to talk about some of the toughest stuff, these are the homes that you buy for $20,000 and you run on an Excel sheet and you go, man, I'm going to make so much money. And then 12 months later, you're like, this was the worst thing that I ever did. I'm far too.
I got a friend. He's trying to get me into the Detroit homes. He was like, we got it, right? They're like 10 to 20 grand. I'm like, let me know how that goes for about a year.
People would come to me, how can I lose? This home's $500. And I'm like, let me show the ways. So on paper, it would look great. It would look like you're going to make all this money. It's this great thing. But in reality, it would be really horrible. The new construction stuff is the reverse. On paper, you look at it and you go 7 or 8 cap. I could buy that home in Detroit with a 12 cap. And you're like, but then what ends up happening is at the end of the year, you're like, whoa, there were no expenses because it's brand new. So everything is basically warranted. Like, you're not going to replace your furnace. You're not going to have a plumbing problem. You're not going to have a roof problem. You're not going to have a siding problem. These things just handle themselves, right? So that works. Our average rent's $2,400 a month. Now in California, that might get you a 1-bedroom apartment. In the Midwest, this is a lot of money, right? So this is more of a high-end client who I describe as mostly relocating. So the last point, which the perception is exactly what you said, is, hey, that person will stay a long time. Actually, that's the one that I lose on. So the one that we lose on is they'll move to the area, they're relocating, they're coming in with a new company, whatever, want to kind of figure it out. They'll stay for 12 to 24 months. They'll pay, they take care of it. They like hire a cleaning person when they leave, but they don't stay for 10 years. Like that kind of a resident, this person has a lot of options. They're probably going to go buy a home. Our average credit is over 700 and our average income is over $100,000 a year. That's an eventual buyer. And that's okay. We understand, like, we're not trying to be their home for the rest of their life. We just want to be a great spot for them to stop off, have a good experience, have a high quality home that's brand new, and then they can move on. So,
okay. So what about Airbnb? Let's shift a little bit. Why not Airbnb it out, Mike? Have you explored that? Maybe you are doing some of that. Tell us about that, or even like traveling nurses, like maybe those are more professional, maybe 6 or 12 month type of lease, but they pay a little bit more.
Great business. All right. So there's a lot of money to be made for that. In our area, that's kind of up and down Lake Michigan. There's a lot of tourism and stuff that goes on there. We actually started building about a dozen homes that were going to be that, hey, new construction Airbnb. And then the city that we did it in changed the ordinances and said, you can't do this right in the middle of our little project. Now, we were able to just kind of sell them off as single family homes, and it was okay. At the end of the day, we kind of assessed, like, if we're trying to build a long-term business and build out hundreds of properties, to just be sort of at the whims of a municipality deciding that, what we're offering isn't going to work, was something that we just didn't want to be exposed to. But that's a great business. I know a lot of people that are very successful with it. It just isn't our business.
Got it. Okay, makes sense. What about traveling nurses? So maybe they're staying for 6 or 12 or months, and they're paying a little more. Have you looked at that at all?
So we will do a short-term lease at double the rent. So if we're offering 2,300, we'll do it for 46. And you kind of go, who would take that? And the answer is not very many people. A traveling nurse probably won't. The only people that we do that to are usually insurance companies. Somebody whose house may be burned down, the insurance company is going to pay for it. And in Michigan, there's just almost nothing where people will offer a 4-bedroom home on a less than 1 year basis. So we'll do that. What we found is our turn costs eat up the potential gains unless we're in that range.
What's the average turn cost?
We want it to be $500. So I'll start with that. The way that this kind of works is 10 of them are like $0. And then one of them is like $5,000.
Got it.
So the average is a little deceptive, but it does work out once you spread them across enough homes.
How do you define a short-term lease, or what's the time period?
Under 12 months for us.
Okay. So if it's under 12 months and it's something like a traveling nurse or something like that, you're saying, okay, or some kind of fire or some kind of natural disaster, you'll double the rent and say, we'll do it for less than 12 months if you'll pay double the rent. Is that a fair summary?
Yeah. And most people say no, and we say that's fine.
Yeah. Now, what about cost to build? What's the average, price per square foot? What's the average square foot you're building at? What's the total cost from buying the land, developing the land, all in?
I had a friend in California, and he was like, man, we might have to just add zeros to everything that you're doing because this doesn't seem right. So I think one of the advantages of the Midwest is that we're able to build stuff at prices where you go, well, that just kind of makes sense. So our homes that we're building, all in with land and construction, are right around $200,000.
And how many square feet?
Our floor plans range from about 18 to 2,200 square feet. That seems to be our wheelhouse. We try to have as many as with 4 bedrooms. We found that that's a big differentiator against an apartment complex, where a lot of times they're 1 or 2 bedrooms. So if we're 4, we're more catering. Although of course we'll take tenants from any kind of anything that's willing to pay, but somebody that maybe has a family needs 4 bedrooms. So we're able to provide that for them.
4 bedrooms plus the office, or just 4 bedrooms?
4 bedrooms, and one could certainly be an office for you, Brett.
Cool. Yeah, just curious on that. Yeah, it's a good strategy. I like it. I'm liking it, Mike. You're answering the questions great. Obviously, you're an absolute pro. What questions haven't I asked you? And by the way, you can connect with Mike Cullis at greatlakeinvestments.com. That's lakeinvestments.com. What question haven't I asked you yet that you want to ask and answer?
Oh, I know I was watching. So first of all, you had some awesome stuff on. I've been doing this for 20 years, and I was like, wow, this guy's got some good tax ideas that I actually hadn't thought of. So I was learning a lot about trusts and stuff, just listening to your podcast. So very grateful for sharing that. I think a lot of people save money. New construction has some good tax advantages. So I'd be happy to kind of go through that a little bit. Some of it's straightforward, right? Like you can depreciate a rental home over 27 and a half years. However, with a new home, you have what's called carry forward depreciation. So there's certain items that we put into a home that you can write off on day one. It works out to be about $40,000 or $50,000 right off the gate. So when we complete a home, if it's $200,000 to build, you get a $40,000 or $50,000 loss, which can be great. So, if we go through and we're building 2 or 4 homes a month, you're racking up $200,000 a month in losses. So that's really nice. Then you're getting
that offsets cap gains tax.
Mm-hmm.
Nice.
Yeah. So I mean, that can be a tremendous win. And then the other thing is like one of the communities that we're building right now is in an opportunity zone. Opportunity zones can be more complicated than they're worth. However, the gist of it, and you may even know more than me, and we spent a lot of time working on this, but the gist of it is that if we hold these homes for 10 years, there's actually no recapture. So what ends up happening on this is we get carry forward depreciation at the beginning, we get depreciation for the next 10 years, and then when we sell it, there's no recapture of that depreciation or any capital gains tax, and you don't have to roll it into a 1031. So there's pros and cons of an opportunity zone. The pro is that right? You can have some tremendous tax savings. What I've found is that the deal has to make sense. Like that's more like just the cherry on the top is sort of, hey, if all of this comes together, then wow, we're going to come out of this in a real good tax position. The con is that often the places that these are located are not where you want to be. So we went through Michigan, and I have located 3 pieces of land in the entire state that are in A schools, fabulous areas, really, really good. One of them, I don't know if you know this, but Pfizer is located. So one of them is part of Pfizer's land. So somehow they pulled that one off. The other 2 are residential. We got one. The rest of them are in places like downtown Detroit, downtown Pontiac, Flint, places that in our area would be very difficult to get a new construction. Like a $200,000 home would be the most expensive home in the city, and it'd be really tricky to pull off. So that's kind of the con. But that could vary from different states, if people are looking at doing that.
Love it. Hey, yeah, let's transition a little bit. Love it, all that stuff about opportunity zones, and that's really cool on the ability to do that immediate carry forward depreciation or loss. So let's transition into the biggest frustration with the 1031 exchange. Right, you've been in the business for a while, done lots of deals, maybe even exited businesses or even stock. Right, what's the biggest frustration when you exit these businesses or real estate, crypto that you've come across with yourself or clients or friends when it comes to the 1031 exchange or capital gains taxes?
Well, so our partnership just sold 283 homes. So it was an $80 million deal. And it was a really high class problem. And I'll start with that. But the discussion was sort of, okay, so we sell this, then what do we do? And that ends up going right into where you're at. Well, now I have a pile of money that I just have to pay a bunch of taxes on. And then what do we do? And in this room, it's a bunch of guys that build homes. So we're like, well, then we would just build more homes. And we're sort of like, well, we already have homes. So why don't we just keep these? Right? So you sort of have this discussion, and inevitably somebody says, well, why don't we do a 1031 exchange? And you go, well, that would be great. But now you're going to be restricted with timeframes, right? So
45 days to identify 180 days. The shotgun wedding. Yeah, keep going. Yeah, keep going.
Yeah, so it's like 6 months to try to close, right? So now I just took a situation where I'm in the captain's chair from a deal standpoint. I have this pile of cash and I can do whatever I want or not do anything or whatever. And all of a sudden someone's got, like a bad analogy, but like a gun to my head, who's saying like, if you don't close, you're going to owe a bunch of money in taxes and all, and I wouldn't have that otherwise, right? So that's a big pain. And then the other thing is matching the dollar amounts. Just because we closed this deal at that value doesn't mean that there's some other deal sitting out there at that value. And then the other problem is going to be your product type. So you may want to diversify out of maybe. We love single family rentals, but we have tons of them. So maybe you want to go and buy something else, and you might not be able to do that. So for me, those are the things that are kind of in those. And I know you have some alternative strategies.
Yeah, in fact, we absolutely do. We absolutely do. All you're saying, the shotgun wedding, right? And the 45-day 180, and all of the old blockbuster way of exiting, which is the 1031 exchange versus the Netflix, what's called the Deferred Sales Trust. We learned about it the hard way. We learned about it the hard way too. I mean, we had clients, friends, and family lose half of everything. The 2008, 2011 crash, and it became apparent that there had to be a better solution. At least we're open to finding one. Discovered the Deferred Sales Trust, and started to learn about it, and really started to focus on building a tax deferred exit strategy, using something that will actually solve the problem, which is the ability to be diversification, liquidity, pay off debt, no like-kind requirement, and with the biggest, most important thing, which is called optimal timing. You can sell high and buy low, all tax deferred. And I know it sounds too good to be true, and your brain explodes because we were taught at Marcus and Millichap, hey, the Navy SEALs of this 1031, we've got all this stuff figured out for real estate and trading. We weren't. In fact, our clients got hurt because of it. And so now we're on a mission to teach and train and coach people how to do this. And you can learn more about that. You can learn more about that at capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. And but it's definitely something that
I just wanted to comment on. So first of all, I was listening to you go through this, and it sounds like an awesome way to be able to accomplish what you're talking about. The biggest thing that I thought was unique is that most brokers, even if I think they knew about this, might not offer it, because I feel like most brokers actually kind of like the 1031 exchange thing. And so I felt like this was a really credit to what you were doing, because brokers kind of like the idea that they've got somebody with a pile of money and they need to buy something in 6 months, because that kind of makes for a sale, right? And then you sort of get a commission, and there's not anything necessarily wrong with that. Like they're abiding by a nice tax law that helps somebody save some money, and it works, and everybody can win. But what you're talking about really, I think, slants towards the consumer. It means that it puts the kind of the ball in their court. If they want to buy something right away, good. But if they don't, they don't really have to. And that might not be perfect for a broker in the short run, because you might actually, maybe with a 1031, you get a faster sale on it. But I think in the long run, it's probably helping the consumer a lot more. I just thought.
Thank you so much.
Thank you so much.
And part of why we started the company. First manager, Marcus and Millichap, he brought in my business partner to speak on the Deferred Sales Trust in 2009, and he was encouraging these alternative to 1031. And then a year and a half later, he was no longer with the company, and a new one came in, and he told me to stop talking about it. I'm like, you're telling me literally that clients have lost half of everything because of the 1031 in one sense, too much debt, not enough liquidity. And we're not going to at least provide or show them the option that potentially could have solved this. Like that makes zero sense. And ultimately led to me just walking away from Marcus because of that stance, at least for that particular manager, right, of that office.
Happier for it now
because now we can provide solutions. And also remember, the 1031 only works for
investment real estate.
It doesn't work for primary homes. We did an $8 million deal in Palo Alto. Primary home development. It doesn't work for businesses. We did a $2.6 million business sale
in Alabama.
It doesn't work for short term, meaning less than a year holding. In fact, we said a $29 million deal in Austin, Texas. Okay, he tied up some land, developed the land, and then traded it all in like a couple days. This is the Deferred Sales Trust. It provides the solution for people, and then once the funds are in the trust, yes, you can invest back in when you want to. And the broker who's smart is going to say, "I'm willing to help them solve their problem in a bigger way." And then once the funds are in there, we can go buy more deals and do more deals.
In the short term,
most qualified intermediaries don't want you to know about this. Most investment real estate brokers don't want you to know about this. They want to keep you in the 1031, mouse in the wheel, right? Because that's how they get paid. And
we have a solution. You don't have
to do that anymore. You can go to capitalgainstaxsolutions.com.
That being said, Mike, are you ready for the lightning round?
Ooh, yes. All right, bring the
All
lightning
right,
round
knowing
there.
what you know now,
knowing what you know now, Mike, if you go back to your 25-year-old self with
nugget,
one golden nugget, make sure to tell yourself to do.
Oh man, put blinders on. I wish I'd ignored a lot of things happening in the world and just focused on my business and doing great for customers. Sometimes you get so caught up in making your people happy or trying to keep your company going, or some interest rates are going up or interest rates are going down, and ultimately I feel like that has had about a 0.01% effect on our business and what we've done, and everything that we've done in our business has had a 99% impact. So that'd be it. I'm sorry, I'll be more lightning. Put blinders
It's good,
on.
Mike. Congratulations. You are the problem. You are the congratulations. You are the solution, right? It's not everything.
Everything is the external. There's a thing called the 20-mile march where these two groups were heading towards the South Pole. I think it's the story goes.
And one group is so focused on the external.
Like they might march
30 miles a day
or no miles a day, or 50 miles one day and 1 mile. And it was all about how cold it was outside and all the challenges in the wind. And the other group just kept marching every day, no matter what. Rain, shine, good weather, 20 miles. They just kept doing blocking and tackling.
And guess what?
They're the ones who got there faster. They're the ones who succeeded on their goals. And that's the whole idea. Like, don't let the external
take you
and distract you
what you know you should be doing, right?
What should you be doing today to move your business forward? Excellent, Mike. Question number two. What's the number one book you recommended or gifted the most in the past year?
This is going to sound funny, but I'm homeschooling my kids, and my most favorite book that we read was with my kids, and it's called The History of the World. It's a 4-part series written for kids, so I liked it. And here's why. So this was not recommended on any other business podcast, I guarantee it. But if you're looking for something good, and you're working with your kids, what it teaches is that what we're facing is not unique. So it actually starts 2,000 years before Christ. It comes all the way to current, and it takes you through the rise and the fall of every empire. And even my 7-year-old, by about the time that we got to like 1200 AD, he's like, here comes another king, and then he's going to get full of himself, and then the people are going to have to overthrow him, and then they're going to rise up and get a new king, and then he's going to get full of himself, and the people are going to have to overthrow, right? And so it just kind of takes you through this, and you sort of realize that like the patterns and everything that we're facing that we think are so unique and so only us, and we're the only people facing it, have happened for 4,000 years. And once you start to kind of like get that we're sort of a drop in the bucket of this whole cycle, I've just actually found that really has helped me with this. So weirdly, I've referred that to a whole bunch of other people that are teaching their kids.
I love it. I'm going to get it. We homeschool kids too. I'm going to get the book. Second to last question. What are you most curious about right now?
Ooh, okay. Robotics in building. So I think that a lot of the like trades are completely overlooked from technology. And I am just like, can I give you the simplest one? And it's from my 9-year-old. So my 9-year-old, I asked him to take the trash out, and he was like, why don't we build a robot that takes the trash out? And my first response, I was like, why don't you take it? And then I was like, darn it, that's actually a really good idea. So we have a bunch of parts and stuff, and we're trying to, that is such a tiny part of like in a home of something that you think about that could have robotic automation, that my 9-year-old has coded a trash can to drive itself down into the street. This stuff is getting really real. The biggest areas for improvement that I see, like in our construction process, that could really cut down on jobs that are incredibly hard. And I don't think it'd eliminate them. I think it would just make people better. Like drywall is so heavy. Using hydraulics and machines and stuff to be able to lift things. Right now, guys are literally climbing on a ladder. It takes 3 guys, lift a 60 sheet thing of drywall, paint. I'm from Detroit. The robotics that are used to paint cars are absolutely out of this world. They're incredible. I mean, I've called every single robotics company in Detroit to help paint a house, and they cannot get their head around the idea of you sit the robot and the thing that you're painting goes by you on an assembly line. And I'm like, why don't we move the robot, and the thing is a house, it just goes around and paints all the walls. But I really think that there's something that can be cracked there, especially with new construction. Like when we come in to paint a house, the entire home is completely open. right? There's no cabinets. There's nothing. It just isn't that difficult to perceive these robots that are already painting 10,000 cars a month to just drag them over and kind of like paint the house. So there's some things there. And my hypothesis on it, I'm losing the lightning round, but my hypothesis is that the people who are trying to build homes offsite and bring them somewhere are incorrect. The thing that they actually need to do is it needs to be more like a carnival. You bring a big, huge truck that actually constructs everything in a more efficient fashion to the site. And then it just spits it all out right at the site. All the waste on these guys that are building everything off site is that you're lugging a home that literally costs it weighs 100 tons. Right? So you have all this efficiency, you're building it somewhere, and then you're lugging it somewhere else. I worked at Pulte when they were trying to build basements off site. We had a factory, we were doing this whole thing. Like concrete on a truck. Really heavy. So we were building the basements here and sending it to as far as Kentucky, right? And so it was very cheap to build it in a factory. And then once you rolled back all the transportation costs and everything, it made no sense. So the idea has always been in my head, and the opportunity is how do you get a basic new home builder that becomes almost like a mechanical truck that shows up on site and spits off pieces of prefab walls to be able to build homes. So there's sort of my dream. In the end, wild goal would be to be able to build a home.
Amazing. Last question.
We're out of time.
Because we're out of time. After all Mike and everything you've done and accomplished, helping the people to build homes, invest homes, businesses, all this stuff. How do you stay centered in your values? What kind of habits do you practice? And how do you stay encouraged to charge forward to reach new heights?
Okay, so I'm a born again Christian. So I was baptized, and for me, staying grounded in that is what has really transformed my life. So there's the lightning round answer.
Amen, brother. I appreciate it, Mike.
For those who want to get in touch with you, where's the best place for them to find you?
Yep. So LinkedIn, search Mike Kalis is really good. I'll respond on there and try to have things up. Mike@GreatLakeRealty.com is my email, and I would be happy to hear. I love helping people. Candidly, all of our investments are full. The only reason we even opened it up to outside investors was because people kept coming to me and asking. I'm sure there'll be something in the future that we'll look at. But if you just have questions around new construction, building homes, investing in homes, I genuinely like. So if I can help,
amazing. Thanks, Mike, for being on the show.
And thanks for encouraging us today.
And I encourage you to keep using the gifts of helping others to make money
and helping people to build businesses, right?
And I love that. And I also want to encourage and thank our listeners for listening to the episode of the Capital Gains Tax Trust podcast, also streaming expert CRE secrets. Remember, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax options and not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated crypto business, real estate, build a home, brand new construction, short-term rentals, all of the above. You just need a plan, to guide you. We want to be that team. We want to help you with that. Go to capitalgainstaxsolutions.com. Check out the new book, by the way, coming out. Really smart people like
Kevin Hearing from Shark Tank in the book,
multifamily syndicators, operators, financial advisors.
It's my story about building a tax for exit strategy. That's what it's called, building a tax for exit strategy. Come out Amazon, so check out that near you soon. Please rate, review, subscribe. Please share this with somebody. Please give it a like. We so appreciate